Today's the 21st of February 2022. My name is David Hickson, and in today's market update we're going to be taking a quick look at the S&P 500 and the Nasdaq, and also gold. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. Let's start with a quick look at the S&P 500, and I'm not going to repeat everything I've said in previous market update videos, so I would encourage you to take a look at previous videos that I have recorded so that you understand the context of what we're discussing today. This is a 3 or 4 year view, and of course we have the 18-month cycle trough in December of 2018, the very big trough in March of 2020, probably a 54-month cycle trough, maybe even longer, a 9-year cycle trough. And this is a slightly unusual analysis which presents the possibility that an 18-month cycle trough formed in January. I say it's an unusual analysis because that makes a very long 18-month cycle, and I know there are many analysts that dismiss this analysis without a second thought because of that very long 18-month cycle. But it does introduce an interesting idea which we're going to take a look at in a moment in the Nasdaq, which I spoke about in last week's market update, which is the fact that in the Nasdaq the 2018 trough seems to be the more prominent trough than the March of 2020 trough. And of course there have been 37.1 months that elapsed from December 2018 until the January 2022 trough, indicating that potentially 2 18-month cycles elapsed during that time. So that is one possibility for the S&P 500. Let's take a look at the other one, the more likely one in my opinion. And here you can see we have exactly the same situation, of course, with the trough in December 2018 and the trough in March of 2020. The big difference with this analysis is that the 18-month cycle trough has been positioned here at the beginning of October. As I mentioned, this is the more likely analysis. We've been discussing this possibility for some time, several months, I believe, because of the fact that 555 or 56 days elapsed from March of 2020 until the October trough. The average length of an 18-month cycle is 546 days, and so that makes the October trough a very likely position for the 18-month cycle trough to have formed. The big problem, of course, is that when we zoom in and take a look at the price action that has elapsed since then, we have a bit of an anomaly, because if this is the 18-month cycle trough that formed at the beginning of October of last year, then that would have been the first 18-month cycle trough to form since the very prominent trough in March of 2020. And following that first 18-month cycle trough, we would expect to see a bullish cycle developing, instead of which we have seen this mixed cycle developing, as you can see here. Why do I say it is mixed? Well, there have been some bullish elements to the cycle that has elapsed since the beginning of October. In particular, of course, we have the late peak. A late peak in terms of time indicates a bullish cycle, but of course it also experienced a lower trough over here in the last week of January, which is obviously a bearish indication, and so we have a mixed cycle shape. Now, as mentioned, of course, when bouncing out of an 18-month cycle trough, we would expect to see a fairly bullish cycle shape to happen at that point, and that has been the subject of discussion in recent market update videos, is what is actually happening here. Why are we not seeing a very bullish cycle? I should point out that in my experience, the markets do have a tendency to do this. Sometimes when a fairly big cycle trough forms, in particular an 18-month cycle trough in this example, sometimes the markets will burst upwards and everything looks wonderfully bullish. Sometimes the first shorter magnitude or smaller magnitude trough that forms can be not as bullish as might be expected, and only after that do the markets actually really take off. So it is possible that that is happening, But what is the situation right now? Well, according to this analysis, of course, we were expecting a 20-week cycle trough to form, and I've discussed this in previous market update videos. It is quite possible that the 20-week cycle trough formed at this position here in the last week of January. But if the 20-week cycle trough did form there, and you can see from the line for the 20-week cycle trough that extends underneath that time period, that it is reasonable to expect a 20-week cycle trough at that particular time. But if that was the first 20-week cycle trough following the 18-month cycle trough of October, then we would have again expected to see more of a bullish cycle shape developing. And yet again, we're not seeing that bullish cycle shape forming in the market. And so there are some questions really to be asked about what is happening. If we take a look at the 20-day FLD, which is this purple line here, you will know that following the formation of a 20-week cycle trough, and on the assumption that that is a potential 20-week cycle trough, we would expect price to find support at the level of the 20-day FLD, which it substantially failed to do. As you can see, it simply dropped back down below the 20-day FLD and certainly failed to find support at that level. That was a warning sign. And it is possible that the 20-week cycle trough still lies ahead of us. As shown in this analysis, here is the nest of lows, indicating that the 20-week cycle trough is actually expected to form pretty much in this week or perhaps even in the week behind us. You can see there have been 143 days that have elapsed since the beginning of October, or since the trough at the beginning of October. The average length of a 20-week cycle is 136 days. If you don't understand why the average length of a 20-week cycle is 136 days, I would encourage you to download the 10 Core Concepts document that there will be a link to beneath this video, which explains the concept of nominal cycles and the average length of those cycles. And so at 143 days, we are only slightly long now for the 20-week cycle trough to form. And so it is indeed possible that the 20-week cycle trough is still in the process of forming. Normally, we would expect price to, of course, drop down to a lower price before forming the 20-week cycle trough. But it is just possible that this price action over here was a little bit of extra volatility, perhaps because of news events that were happening around about the end of January. That is always possible, but I prefer not to rely too heavily on that possibility and rather just simply to look at the evidence of the price action. And so we certainly have a bit of an anomaly in terms of what is happening in the markets at the moment. And it's an interesting anomaly because it is happening in many markets. It's also happening in the Nasdaq, which we're going to take a look at in a moment, and indeed in cryptocurrencies. Bitcoin and Ethereum have pretty much exactly the same situation, where we are expecting a fairly major trough, either a trough of 20-week magnitude or a trough of 18-month magnitude, and we are simply not seeing the bullishness that we would have expected. So we're going to be watching this very carefully. If price does now finally manage to burst upwards, then we will either confirm this trough having formed, where the trough does form as a 20-week magnitude trough, or of course it is possible that we have the 18-month cycle trough forming round about now, or perhaps at the end of January. Let's go and take a look at that option quickly. Here is that option with the 20-week cycle trough at the end of January. You can see there have been 28 days since that trough formed. Again, price, of course, dropped down below the 20-day FLD, indicating a failure in terms of the bull really taking off and confirming that 18-month cycle trough. The reasonable length of time in which we could expect the 20-day cycle trough to form is pretty much past us at a length of 28 days. And so the next trough that we're looking at, if indeed this was a trough of 18-month magnitude, or indeed if the 20-week cycle trough formed at that point, would be a 40-day cycle trough. And so we're going to be looking for that trough to form in the markets. I would like to quickly point something else out, which is to do with the 40-day FLD. As you know, we often look at the 20-day FLD in these videos because the 20-day FLD is a very reliable one, but we have the same sequence of interactions with all of the FLDs, or I should say with most of the FLDs. There are some subtleties which I won't go into here, but following a trough of at least 20-week magnitude, we would expect our sequence of interactions A, and then at the time of the 40-day cycle trough, a B category interaction which failed to occur, and I have discussed that in previous market update videos, a B and C category interaction, then a D category interaction as price comes down into the 80-day cycle trough, then an E category interaction as price crosses back above the 40-day FLD, then the F category interaction. Now, the interesting part about this FLD, which is the reason I'm showing it, is the fact that price found resistance at the level of the 40-day FLD, indicating that that might well be a G category interaction, which is where we expect price to find resistance at the level of the FLD. And it is now, of course, moving down in an H category interaction, indicating that the 20-week cycle trough probably still lies ahead of us. And so we need to be careful of the fact that price might come down further and form that 20-week cycle trough. Let's take a quick look at the Nasdaq. The situation in the Nasdaq is very similar to the S&P 500. In fact, many markets around the world at the moment are exhibiting exactly the same situation. The interesting thing about the Nasdaq, as discussed in last week's market update video, is the possibility that the 54-month cycle trough occurred in December of 2018 instead of in March of 2020. That would mean that the March 2020 trough was only of 18-month magnitude. This would have been the first 18-month cycle, and the second 18-month cycle possibly completed in October, or indeed might be completing now. We have exactly the same two possibilities in the Nasdaq, in my opinion. The reason why this is a particularly interesting analysis is because it does provide some rationale, if you like, or some explanation for the fact that we might be seeing the markets turning bearish. Because, as I indicated a moment ago, in the S&P 500 we have seen a bearish shape developing, and this possibility in terms of this analysis highlights the reason why that might indeed be happening. If we zoom in here, you can see that we have exactly the same situation in the Nasdaq. Only 140 days have elapsed since the early October trough of potential 18-month magnitude. And so you can see in this analysis the 20-week cycle trough is expected to occur pretty much this week. I'm recording this video before the markets open in the US, and so we shouldn't take this bar too seriously. It represents a little bit of overnight trading on Sunday night. And again, it is quite possible that we're going to see price coming down and forming a slightly lower trough here for the 20-week cycle trough. But we also have exactly the same possibility in the Nasdaq, which is that the 18-month cycle trough, or indeed the 20-week cycle trough, formed on the 24th of January. So let's quickly take a look at that. Here is that possibility. It is a viable analysis. Again, it gives us a very long 18-month cycle, and so it's probably not my preferred analysis. I prefer the other one, but certainly it is possible, and we have our 28 days here. As you can see, the 20-day cycle trough really should lie behind us, indicating that the next trough, according to this analysis, would be of 40-day magnitude. And so we have exactly the same two possibilities, in my opinion, in the S&P 500 and the Nasdaq. It's very difficult to argue our way to absolutely support one possibility or the other. And so I'm not going to waste time doing that. I simply point them out, and we need to keep a close eye on what is happening, and in particular keep a close eye on our FLDs to see what our FLDs are doing. Here are the 20-day FLD and the 40-day FLD for this analysis in the Nasdaq, and so we are going to be watching those very carefully to see how price interacts with them, to see if we can get some firm evidence in terms of which of these analyses is actually playing out. I thought it would be very interesting today to take a look at gold, because some interesting things are happening in gold right now, which might explain to some extent what is happening in the other markets around the world. And so let's start by taking a very big step back, because it's been a little while since I spoke about gold. The first thing I'd like to say about gold is that, as you can see, we have two analyses on this chart. There are some triangles at the top of the chart, which are the results of performing an analysis, assuming that the cycles that influence the price movements of gold are synchronized at their peaks. It's what we call a peak analysis. And at the foot of the chart, we have our diamonds, which are the results of an analysis performed assuming that the cycles are synchronized at their troughs. Now, one or other of those things can only be possible at any one time. It is possible that at certain times cycles are synchronized at their peaks, and that at other times cycles are synchronized at their troughs. That's a fairly interesting idea that we won't discuss now, because it's a conversation that could carry on for a really long time. The important thing about gold is that, in my opinion, the cycles are most probably synchronized at their peaks, indicating that the analysis we should be focusing on is this peak analysis. Nevertheless, it is interesting, in my opinion, to keep an eye on the trough analysis, because sometimes it provides us with a little bit of insight. The important thing about this analysis, as I think you can see, is that we have two very clear peaks. We have this peak back in September of 2011, and then we have this peak over here, which occurred in August of 2020. And you can see that the length of time between those peaks was 3,256 days. I've spoken about this in previous market updates about gold, so I won't dwell on it, but that is very close to the perfect nominal length for a 9-year cycle, according to Hurst. And so the possibility or the probability that this peak back here in 2020 was a 9-year cycle peak is, in my opinion, very high. And so that is really the basis for where we are starting our consideration today, is the fact that we experienced a 9-year cycle peak over here in, I think that was in early August 2020. If that is the case, then what is happening now? Well, it's really quite clear. At the top of this chart, we have a nest of highs for the 18-month cycle peak. And so clearly what is happening now is that the price of gold is moving up into an 18-month cycle peak. It is my opinion that that is what is happening, and so we need to keep a very close eye on the formation of that 18-month cycle peak. That would, of course, be the first 18-month cycle. Then we are likely to get a second 18-month cycle, of course, before we get a really big magnitude peak of 54 months. And so this 18-month cycle peak is likely to be a fairly important one. It's going to be a bit of a peak in price, something certainly worth looking out for. And if we take a look at these bar counts, you can see there have been 563 days since this peak in 2020. The average length of an 18-month cycle is 546 days. So we are a couple of weeks overdue for that 18-month cycle peak. Here we have another count, 265 days since the 40-week cycle peak over here in about the middle of last year. And the average length of a 40-week cycle, which is of course the duration that we are counting from the previous 40-week cycle peak, is 272 bars. So we've got about another week to go until that 40-week cycle peak is expected. And so the price of gold is almost certainly approaching an 18-month cycle peak. It's something to watch out for. As the price of gold approaches that peak, it is not unusual to experience some distortion in stock markets, because gold is, of course, traditionally known as a holder of value, and as the price of gold increases, many people are perhaps moving their focus into gold. When gold forms that 18-month cycle peak, we are likely to experience a bit of a turnaround in stock markets as well. And so it could well be that these markets are moving with a form of inverse correlation, if you like, at the moment. And so that 18-month cycle peak in gold is certainly one that we need to be looking out for. I do hope that you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.